It's human versus AI today on Your Money Matters. Wondering what we're talking about? Well, it turns out, and this is something my producer told me, a lot of people are going to the various large language models out there, your chatbots, ChatGPT, etc., and asking for advice on financial planning. And so I thought, why don't we discuss real-world cases with a financial planner and compare it with the responses that you get if you feed the same queries into a chatbot. And we'll discuss both with the financial planner I'm speaking to today. Let's see what turns up. We've got Megha Malpani, who is a partner at Zvest Financial Services, joining me today. Megha, thanks so much for taking the time. I'm intrigued about what your responses are going to be and what the chatbot throws up. I'm sure that there will be parallels, but there's a more involved process. It's not just the outcome, right, when you're talking to a financial planner. So let me get started with the first question, which actually is somebody who wrote to me on Instagram. And he's saying that he's buying a house in his hometown and he has a home loan of 40 lakh rupees, or will have a home loan of 40 lakh rupees by March. And that is by the time it is complete. He says that he's put 40 lakhs in cash. His question is, he's anticipating an incoming amount of about 40 lakh rupees in March. Should he pay 20 lakh towards a loan and invest the remaining in mutual fund and slowly pay off the loan? Or should he completely clear off the home loan? He says he's 35 years old. He's got his mutual fund investments in Parag Parikh Flexi Cap Fund, which is worth about 40 lakh rupees right now. He wants to hit that 1 crore mark ASAP. He's not defined what the time frame is, but it's ASAP, and his currently monthly SIP is 60,000 rupees. So what would you take from that information?
Right. Thanks, Alex, for having me here. And, this case the query is quite common, wherein we often get cases about prepaying a home loan versus investing. Now, the way we advise is on 3 parameters. I think, if you try to understand it from 3 perspectives, psychological, financial, and from a taxation angle. To my mind, psychological aspect is as important as the financial aspect, and let's try to decode what it is. Now, if someone is debt averse, is not very financially prudent or not very disciplined, and does not have the ability to handle drawdowns which equity market is going to present at different points in time, it is better to prepay the loan. However, if these conditions are not met, from the psychological aspect, one can easily move to the financial analysis bit. Now, as far as the financial analysis bit is concerned, let's analyze it from 3 or 4 important parameters. First being whether he's a sole earning member in the family and who are the financial dependents. Now, if he's married, his spouse is working, then it might be prudent to consider taking the loan. However, if parents are financial dependents, the risk transfers have not happened yet, then, taking a liability does not make too much of sense, given the fact that there are inflows to cover the home loan. Also, it is important to consider where he is working and what is the stability of the job, especially in the given scenario. Whether you're working for a startup, whether it is technology, or you're more, towards the professional services bit, that would also help us ascertain how stable the job is. Third important point being, at what rate of interest can one take a loan? Now, to my mind, for the next 12 to 24 months, a realistic rate of return expectation would be in the range of 12 to 13%. Let's take 12%, for example. The post-tax return would be around 10.5%. Take 10% deviation, we come down to about 9%. So if the home loan is available at a rate which is more than 9%, the answer is a clear no towards taking a home loan. However, if the investor is getting a rate of interest which is, at least 100 basis points lower than 9%, it may make sense to consider taking the loan. Also, it is important to analyze whether how much percentage would be left, after paying the EMI. So if EMI constitutes a larger part of his take-home salary, which could be in the range of 40 to 50%, the answer is again a clear no. Now, from the taxation perspective, the new tax regime actually does not offer any advantage to taking a loan per se anymore. These conditions have to be considered, together to ascertain whether he should take a loan or not. Now, as far as, reaching the goal of 1 CR ASAP is concerned, and as you rightly pointed out, ASAP is not defined. However, to my mind, I have few observations. One, 40 lakhs in a Parag Parik FlexiCap kind of a fund. It is a good fund, no doubt, having generated meaningful alpha over the years. However, going forward, it would become important and prudent to, kind of rely on asset allocation parameters. Now, if he is partially paying the loan and the remaining has to be invested, he might want to bucket his expenses from a time horizon point of view. Say, for example, a 1 to 2 years kind of a bucket could go into equity savings or could go into an income arbitrage kind of a fund. If he's investing lump sum for a longer period in the given market situation, he may consider, hybrids, large cap and large cap based flexi cap funds through an STP mechanism, not to do lump sum at this point in time.
Yeah.
Also, it would make sense to incrementally keep adding to SIPs as and when you kind of get bonuses, salary hikes, and as and when you get bonuses or any windfall gains in the form of bonuses or anything else, it might be okay to prepay the loan because there is no pre-penalty as far as a home loan is concerned. So to my mind, once you kind of build a framework on the above on the parameters I just alluded to, it would we would be better in a better position to address whether he should take a loan or not take a loan.
Okay, so fair point. What I'll do is let me run through what is being said by the chatbot. And it's not really pointing out to one option. It's presenting the options and saying, you can choose what you think is the best option. So the first option that is being suggested is you can pay off the full 40 lakh loan. This makes you debt-free according to the chatbot and saves on interest, potentially to the tune of 3 to 4 lakhs per year at about 8%. It would be slightly lower than that if you're at the higher scores with regard to your credit score, and then reduces stress as well, something that is not really measurable, and use future SIPs to rebuild investments towards that 1 crore mark. I guess this is something that people who are risk averse in terms of debt can consider. The second option that is talked about is pay 20 lakhs towards the loan and invest 20 lakh in mutual funds. You can keep the reduced loan and pay EMIs while investing the rest in the same fund, is what the chatbot has said. It says that you can keep the reduced, alternatively, you can keep the reduced loan and you can invest the rest. If mutual fund returns exceed the loan interest, which is likely, your corpus is growing faster and you're likely to hit 1 crore faster, but the market risks also apply. They're saying that the recommended way to approach this is to go partial if comfortable with the risk and invest 20 lakh rupees to accelerate growth, as the math favors it over loan costs. Increase the SIP if possible in order to reach that 1 crore mark faster. So it's a pretty straightforward response to a query. My assumption, Megha, would be that it would give you more parameters if you were to prompt it further. But what was your initial take on it?
So, Alex, as they say, personal finance is more personal than it is finance, right? So, to my mind, it is important to understand an investor from a behavioral perspective. So, if you saw, I kind of recommended to see the psychological aspect first before moving to the financial implication, because as you rightly said that somebody is debt averse and does not have the ability to handle drawdowns, it would kind of make you falter on both sides. You have taken a loan and you're also seeing kind of market correcting. So I think about AI, it gives you more certain recommendations, whereas when you're kind of dealing with somebody in person, it helps you in understanding the context context much better. So, of course, prompts are important. And to my mind, I think also what happens is, life is also very volatile. It is like a stock market in itself, right? You have recessions, you have job transitions, there could be illnesses, there could be, so many host of factors, right? So you need to kind of, once you have somebody to speak to, it kind of helps you to get reassurance when you need and avoids you from taking any ad hoc decisions. I would not recommend continuing in the same fund forever, because while it is a good fund, but it is also important to understand that mutual funds also go through cycles. No Q1 fund remains a Q1 fund forever. And I'm someone, who strongly believes in asset allocation. So there is no debt here. There are no hybrids here. There is no precious metals here. There is no
why don't we
offshore
suggest,
equity
and
here.
by the way, this is a question from a real user who's reached out to me on social media. His name is Sayam Kumar. So why don't you suggest, Megha, how he can take this up? And of course, at this point, the caveat is that he's not stipulated any of his long-term goals, which is okay. He's 35 years old. Maybe he doesn't have clarity. And he wants to reach that 1 crore mark, which a lot of people, Megha, see as your first step, which allows you that multiplicative growth down the line, right? So why don't we help him, or rather you, not me, I'm just asking the question, about how he can have that appropriate asset allocation, maybe add a couple more equity mutual fund schemes, just so that he has that diversity, not just in market capitalization, but also possibly in style. You can also list out a few that you like.
You want me to mention the funds?
Yeah, and it's not a recommendation, but you can say from your perspective, this is what you would do.
Yeah, so, this is not a recommendation because I do not know the investor. I have not evaluated him on other parameters, but some of the funds in the hybrid space, ICICI Prudential Balanced Advantage Fund is good. In terms of large cap, DSP large cap is nice. In terms of flexi cap, SBI Focused Equity Fund, Parag Parikh Flexi Cap Fund, ABSL Flexi Cap Fund has recently started doing well. In terms of mid cap funds, one can consider HDFC. In terms of small cap, you can consider SBI Small Cap or a Bandhan Small Cap. Gift City, I'm not sure, if it makes sense at this point in time. And, the caveat as far as offshore equities are concerned, funds keep, accepting and stopping any further increments. So, one needs to also consider at the time of making investments. But, at least it is important to have not just, diversification in terms of market cap, but also in style of investing, right? Because if you understand, Parag Parikh Flexi Cap Fund is largely a value style of investing, and value has done very well for the last 4 to 5 years. We are kind of seeing green shoots as far as quality parameters are concerned, and it might make sense to kind of add those to your investment consideration set as well.
Let me ask you this. So suppose he's got a 60,000 rupees, as he's pointed out, right? So 60,000 rupee SIP right now, and he's got incrementally 20 lakhs that he can invest. So what would he do with that additional 20 lakh rupees if he pays off 20 lakh rupees and he uses 20 lakh rupees? That's the middle ground, assuming that he can do that, and assuming that he can. Let's put two scenarios, right? If he invests the entire 40 lakh rupees plus continues his SIP of 60,000 rupees, if he does 20 lakh rupees, if he does the 60,000 rupees, incrementally, how can he shift his allocation?
Yeah. So, the lump sum allocation, as I said, can be done through STPs, more in hybrid and the large cap, flexi cap category. And the mid and small cap, precious metals, etc., can be done through the SIP route. So that way, given where the valuations for mid, small cap and precious metals is, a larger holding period and also a longer deployment period would help fade out the volatility. And as far as the lump sum goes, that can go into categories which are more fairly valued at this point in time, of course, through STPs.
Okay, and just finally, Megha, just to drive home the point for Sayam, what should his ideal allocation be towards equity and then these balanced advantage, etc.?
Alex, that's a very difficult question to answer
Fair.
because, I would not know anything more about him than the information that you have shared. So I don't think I would be in a position to give, exact range of percentage allocation right away.
Okay, that's a fair, and that's a good answer. Let me take you through the second question. And this is Pallavi Singh who's asking this. She says she's 25 years old. She's got no SIPs running except for a corpus of 1 lakh rupees that is locked in an ELSS fund that matures in October of 2027. She's confused right now about how much to save as an emergency or for emergencies, and how much to invest in mutual funds to take a budget trip to the US in the next 3 years. She's got a salary of 90,000 rupees and she's wondering how to go about saving and investing to achieve this goal. It's a relatively more straightforward question. Do you agree?
Yeah, and a tough one.
So, but how would you approach this?
Yeah. So first, I think Pallavi, she should kind of focus on building the emergency fund, and the emergency fund, how much to have is again, subject to the parameters we laid out in the earlier case as well, which is about stability of income, job security, financial dependence. Have the risk transfers been done for self and for the dependents again? Now, if these are in place, considering there are no other savings whatsoever except that 1 lakh, which is also in a locked-in product till, I guess, October 2027, one might want to have about 9 to 10 months of monthly expenses in an emergency fund. What we always suggest is in early years of investing, because there are no other, while money is fungible, as the portfolio advances, different pockets offer liquidity needs without a potential drawdown. However, in the early years, that is not the case, and we recommend 9 to 10 months of monthly expenses to be saved. If these are not in place, as in the job has significant threats, etc., then maybe you would want to consider to increase the emergency corpus significantly. Now, as far as the US trip is concerned, I think let's break down the expenses into different categories, ranging from tickets, visa costs, in-country travel, flights, etc., accommodation, sightseeing, etc. Let's, for the sake of simplicity, assume she is doing a 15-day trip. Now, travel, flights would be in the range of 70 to 75,000 if done at least with a 6-month kind of a window. If you talk about doing a budget trip, which would be, kind of staying more in hostels and not spending on cabs, etc., food, etc., all put together would range in an approximate range of 10 to 15,000 rupees a day. Multiply that by 15, you're talking about 1.5 to 2 lakhs of expenses. Internal flights, sightseeing, etc., would be again in the range of 1 to 1.5 lakhs. Let's understand that, the Indian rupee has depreciated in the range of 3 to 3.5% every year. Assuming this was to continue, the number of 3.25 to 4.25 lakhs that we estimated would actually move to about 3.6 to about 4.6 lakhs. Now, add to it travel inflation and another sundry expenses, we are talking about 4.5 to 5 lakhs of expenses, which, she would probably have if she's planning to do an US trip 3 years from now. Now, understand that you are not going to be needing everything at the end of 3 years when you're doing the trip. The tickets, the hotels, etc., have to be booked at least 6 months in advance. So you actually have a runway of only 2.5 years. And equity, by its nature, might not be the most prudent category to invest in with that kind of a time horizon. So my advice here would be that, the amount which is left in ELSS, because it would kind of, cover at least 4-ish years, 4.5 years, can be used for any advance bookings she would have to do to, about 6 months ahead of the trip. But it is very, very important for her that she also starts planning her building her other corpus and long-term equity objectives also. So to my mind and my calculation would suggest that a SIP of around 12,500, assuming a 10% kind of a post-tax return into a hybrid kind of a fund, would be best suited in this case. But it is also important to understand that this is a discretionary expense, and if markets do not work in your favor, it may make sense to defer the decision, by a year or so if need be. So one has to be prepared for that. But other than that, emergency corpus is extremely important, and also, also start investing towards other objectives and goals.
The one thing that you may not have considered, Megha, I don't know if you have, but have you considered incrementally increasing the amount that she invests every year for the next 2 years? Because we're now nearly at the end of a salary cycle, right? So you've got new salaries that kick in April, hopefully, for this person as well, for Pallavi. You can look at a 25-year-old getting, between 9 and 11% every year. Let's hope that that's the case, right? So you could have incrementally an increase in the amount that she can save by 10% every year. Is that something that can move the needle by a little bit at least?
Yeah, it should, because that is a given rule that with your increments in place, one should look at stepping up the SIPs on a yearly basis. Whenever you kind of sitting and doing your reviews, I think that is an important item to consider always.
Okay, so this is what the AI bot had to say. It says build an emergency fund first. Aim for 3 to 6 months of expenses. So assuming that your expenses are 50,000 rupees per month, then you should have 1.5 to 3 lakh rupees in a savings account or in a liquid fund for safety. The estimate of the US fund has been kept at 2.5 to 4 lakh rupees in 2026 based on current trends. So it's not really given you the projection as you've given, Megha, accounting for rupee depreciation heading into 2028, right? Or thereabouts, 2028, 29. The monthly savings plan with 90,000 rupees, it says cut expenses to save 30 to 40,000 rupees a month. I think somebody with higher income is capable of doing 30%. It's not so easy for people at 25, especially if they're living in places like Mumbai and Bengaluru. But assuming that they can do this, 30% is quite a significant amount. And after the emergency fund, they're saying invest 20 to 30,000 rupees in low-risk mutual funds, that is debt or hybrid. This kind of fits with what you were saying as well, for 3 years in order to grow safely towards the TRIP goal. They've also given suggestions here on things like an HDFC hybrid debt fund or an ICICI Pru short-term fund, which is not going to give you a very high return at this point. It says that you can use that ELSS down the line as well. It says that you can use the ELSS as a boost down the line, and you should track your progress every 6 months and adjust savings. You want to add something to this at all? It kind of rhymes with what you're saying, if it didn't exactly give all of the details that you did.
Yeah, I think this is more in line with whatever I have said. However, it is also important to consider, Alex, that she's just 25. So, I would not ideally give her, debt and hybrids for funds which are except for the US funding. Right? We might want to resort to more equity-oriented schemes given the long time horizon she may have, but that is, of course, we'll know better once, we have better and more nuanced details.
But Megha, if a 25-year-old with practically no savings came to you and said, look, I want to do a US trip in 3 years, as their financial planner, wouldn't you say, hey, you know what, maybe you should consider a cheaper option? Maybe go to...
I would definitely do that.
Maybe go to Bali.
I would definitely do that.
Maybe go to Bali, you'll save a lot more. So I'm just saying, for somebody that old, wouldn't you say that this is the best time to start investing so that when you're 40 years old, you can do 3 US trips in a year?
Absolutely, because see, we do work with younger investors and we see that they actually want to take more frequent trips. So they kind of do not look at expensive options like, the US to begin with. So you're right, a Bali or a Thailand would be a much better option.
Okay, all right. On that note, I think we've had a pretty interesting conversation, man versus or woman versus machine. Megha, thanks so much for playing the role and for a lovely conversation.
All right, pleasure talking to you, Alex. Bye.
All right, well, take advice from artificial intelligence which with a pinch of salt. And sometimes it's better to have a conversation with somebody just so that you can hear from them that you're not necessarily making the right choice with your money habits. Thanks so much for watching. Do stay tuned. This is NDTV Profit.